All right, hello everybody, and welcome to the episode on my channel. So we have an exciting video here for you this week. We are going to be looking at the most recent Investor Day presentation from one of my holdings, that being Brookfield Asset Management. So Brookfield Asset Management, or BAM, makes up about 3.6% of my total YouTube dividend growth portfolio that I share with you here on this channel. And now, if you are a avid viewer of mine or you've seen my past videos, you would have also seen my video last week regarding Brookfield Corporation, where I explained their most recent Investor Day presentation. I went through their specific financials, their specific financial metrics, the reasons why they believe they will be poised for great growth over the foreseeable future, and why I believe Brookfield is going to be one of my best performing securities in my YouTube dividend growth portfolio. Now, if you haven't seen that video, I will leave a link in the top right hand corner for you to watch, which you should be seeing right now. All right, so without any further ado, I will go and dive right into the Brookfield Asset Management most recent Investor Day presentation. Now, I'm going to be looking specifically at the financial plan and corporate finance strategy as was presented by their CFO. All right, so they're stating 5 years ago they set their expectations high for Brookfield Asset Management. So in 2018, they told investors that they plan to double the fee-bearing capital of Brookfield Asset Management by 2023. So the original plan in 2018 was to go from $129 billion of fee-bearing capital, or FBC, and grow that at a 14% compound annual growth rate. So again, that's 14% per year growing of this fee-bearing capital up until 2023 of $245 billion. Again, this was the original plan. Now, if we fast forward to their actual results, we can see that they've more than tripled that growth. So that original 14% compound annual growth rate of that fee-bearing capital has now grown to 27% per year for the past 5 years. Again, that was the plan previously. Now this was the plan at 129 billion, or the actual fee-bearing capital they had. It actually came out to $440 billion of fee-bearing capital, resulting in this tripling of fee-bearing capital. Again, just great outperformance there by Brookfield Asset Management. So driving their 5-year cumulative fee-related earnings, or as you'll see later in the presentation, they refer to them as FRE, they were higher than their 2018 projections. So here in the green, that was their Investor Day projections that they communicated originally 5 years ago. Then here in the blue is their actuals. So cumulatively, or in aggregate, they projected 7.6 billion of fee-related earnings previously, and the actuals, or their actual results for those 5 years, was 8.3 billion. So again, beating their own expectations. So great performance here by Brookfield Asset Management. Now, they state that they were able to achieve this growth due to a few key factors. So number 1, 2, and 3. 1 being the new business lines and strategies. So they had a transition fund, the onboarding of the insurance solutions and the reinsurance business, and the private wealth channel. Now, 2 being their large flagship, or what they call, I would say, original or key funds. So they raised the largest closed-end infrastructure fund ever, and they believe all subsequent vintages have outsized predecessors. So great key contributing factors here. Now, the third factor here being the Oak Tree acquisition, or the Oak Tree private wealth acquisition, or private credit. Now, it has established scaled credit capabilities, accelerated the growth of that $100 billion credit manager. All right, so here they're stating BAM has come a long way since the previous year's Investor Day presentation. Again, it's only been a year since the past presentation, so we're going to be looking at why they say it has come a long way. So in December 2022, again, if you have been watching my channel, you would be familiar with all of this, but if you weren't, that's fine. I'll state it here again. In December 2022, Brookfield Asset Management actually spun off into 2 separate companies or entities. one being Brookfield Corporation and the other being Brookfield Asset Management, which is a pure play global alternative asset manager. Now, the reasons why this was spun off was essentially, in my opinion, to just be a better comparable or a better, I would like to say, more easily understandable investment for investors. So the model, as they say, was more comparable to industry peers. They simplified the business, consisting primarily of these stable fee-related earnings, long-term cash annuity business. So when they state this, they are referring to the revenues, the fees that are related to the certain investments that they make for their investors. It has a cash annuity like quality. So those fees, a lot of the times, the funds for investment are invested into assets and locked up into long-term contracts, such as 10 or 15 years. Some are even perpetual. So that meaning that they are locked in basically for the life of the asset, or as negotiated between Brookfield and the investor, resulting in long-term cash or revenue like annuities or business. Now, the dedicated management team for asset management business, again, this speaking to the separation or the development of the management team or executives specifically for the asset management business, not just for Brookfield Corporation alone. Here they say BAM security has been well received in the public markets. Again, I almost do not agree with this. Again, they are speaking to how they perceive their perception of BAM in the public markets. Originally in December 2022, I feel like a lot of people were confused with how this came out. And again, now that time has passed, it almost being 9 months since that happened, or 10 months, it does make a lot more sense. I feel like the public has had time to digest it, and now that people are able to actually make investing decisions based off of specific quantifiable knowledge, as they've had history with BAM now for a decent amount of time. All right, so BAM operates in industry-leading metrics. Here, 100% of the DE, or distributable earnings, is FRE, or fee-related earnings. So again, 100% of the distributable earnings is fee-related earnings. So this slide here is speaking to the simplicity of the business. And again, in my opinion, just because things are simple does not mean that they are great. A lot of the best investments in the world are simple cash flowing investments. So 100% of the distributable earnings is fee-related earnings. 85% of that capital is long-term capital, like I spoke to above. Again, invested for very, very long time periods. Can be decades, can be perpetual, like I stated before. The margins, very high margin business, 55 to 60% margin, and they're projecting for these margins to go even higher than 60%, so 60% plus. The target growth rates for this business are 15 to 20% per year. So again, compounding annually at this 15% to 20% per year. Now, what's really cool about this is for all those dividend investors out there, and I would almost say it's analogous to a REIT or a real estate investment trust, they have a very high payout ratio. So 90% plus dividend payout ratio here. So you know you're getting that income from Brookfield Asset Management, as the management is targeting for this 90% dividend payout ratio. Again, like I said, almost think about it like a REIT. They are paying out these dividends straight to their investors, and they have a specific, very high payout ratio. So for those income oriented investors, they love to see those high earnings, and all of those earnings being paid out to them as shareholders. So no debt, asset light balance sheet. All of the debt is held with the corporation and all of the other subsidiaries or the assets themselves. So the actual Brookfield Asset Management has no debt on their balance sheet. And if you've seen my past videos on Brookfield Asset Management, I believe I did one about a month ago. It's titled Brookfield Asset Management. Feel free to go and check that out. I actually break down their income statement and balance sheet. It's very, very great, and it's a super easy to understand balance sheet. So great slide here in my opinion. All right, so they've maintained their double-digit growth of FBC, or fee-bearing capital. Again, that is the capital on which they are able to charge these fees or earn this revenue. So in 2022, comparing from last year to 2023 here, so Again, the renewable and power transition, relatively the same here in terms of fee-bearing capital. Where you're going to see the large jumps are infrastructure and credit and insurance solutions. So there has been a large focus on this infrastructure and this credit and insurance solutions business. Again, major growth as they kick off the reinsurance business. They're making some large acquisitions, which again I explained in my past video of the American Equity Life, which will actually bring their reinsurance business up to 100 billion in assets. And then again, that float or that capital will then be managed by Brookfield Asset Management and allow Brookfield Asset Management to continue to earn these this fee bearing capital or fee bearing fees. So they'll be able to earn fees off of that capital which they manage for the insurance solutions business. So as you can see here, the total fee bearing capital grown at a 12% rate from the previous year. And as they state again, they've significantly expanded their infrastructure and credit platforms. All right, so this enables them to grow their key value drivers at a consistently strong pace. So looking at those fee revenues growing at 15% per year from the previous year, those fee-related earnings, like I said, they have grown up at 16% per year, and the distributable earnings, again, growing in line at 14% per year. So this, again, just year over year, great results for Brookfield Asset Management in terms of fees and distributable earnings. So they're stating that they expect growth to accelerate in the second half of the year in terms of that fee-bearing capital or that base that they can charge those fees on. And then what they're stating here is really cool. So in 2022, at the year end, we're going to have 418 billion of FBC or fee-bearing capital, and they're projecting for that to compound at the end of 2023 to 530 billion. Now, this is a very high rate at 27% for just the second half of the year. What you need to take into account here is that onboarding of the American Equity Life, which is going to bring their insurance capital up another 55 billion. So when you think about it, this is still growing at a very high rate, but a lot of that will be onboarding from the AEL or American Equity Life transaction in their reinsurance business. All right, so this slide right here is just saying that they've invested a lot into their platform. They've added, 200 investment professionals, 300 corporate professionals, and they've built out a lot of these channels and launched a lot of new strategies. Basically, what they're saying here is they're investing for the future, and they should start to see a lot of these benefits from these investments over the next year. Again, just stating that they are reinvesting for future growth. Okay, looking ahead to the future. So fee-bearing capital should surpass $1 trillion within the next 5 years. So remember, right now they're at 418 billion. They think is going to more than double within the next 5 years. So when fee-bearing capital gets higher or raises to these high levels, then their fee-related earnings or that revenue will also increase, because as a result, they will be able to charge more and more fees on a higher amount of fee-bearing capital. So they expect strong growth across all their businesses, especially, again, private credit and insurance, focusing on this business. Over the next 5 years, this is really cool. Even their renewable and transition, they expect the assets or the fee-bearing capital under this renewable power and transition to basically double. The infrastructure, again, very strong growth, increasing by a large margin there over the next 5 years. Private equity, that's very significant growth as well. Real estate, again, significant growth. And the real powerhouse here in terms of growth percentages is going to be credit and insurance solutions. Again, that from 150 billion of that fee-bearing capital up to 500 billion. So great growth here, in my opinion, bringing their total fee-bearing capital up to $1 trillion, or representing an 18% compound annual growth rate here. So they state they expect to maintain these double-digit growth rates, and again, they've delivered on their past plan of the past 5 years, and they actually exceeded it. So for the next 5 years, I'm fairly confident that they will be able to deliver on that as well. So fee-bearing capital growth is driven by long-dated, like I said, and perpetual capital. So again, these are long-dated funds or permanent or perpetual funds. So this is capital that is invested for a very long time. and they are able to earn fees off of this because of the nature of those funds and being long dated or perpetual funds. So long-term private funds, they expect those to grow immensely as well. The permanent capital vehicles, again, tripling here. Perpetual strategies, again, tripling, and liquid strategies adding some growth here as well. So the total fee-bearing capital, again, as you can see here, this is split between the different businesses, and then this is showing you the breakdown of those funds investing into those specific businesses or using those strategies, and that again resulting in a $1 trillion of fee-bearing capital, still representing that 18% compound annual growth rate. And as they state, long-dated capital should grow to 90% of their fee-bearing capital. So 90% being long-dated capital, that is amazing. You know that you're going to have those very, very sticky, or as they say, annuity-like revenues coming in for this foreseeable future. All right, so this slide is breaking down how they're going to achieve that 18% growth from 440 billion in fee-bearing capital to that 1 trillion in fee-bearing capital. So it's going to be a combination of the flagship funds, the complementary strategies, the oak tree strategies, the insurance business being a significant portion here, the listed affiliates, co-invests, again, these are very, very small portions, and then taking out the return of capital and others. So again, this again, very, very realistic in my opinion. They've done it for the past 5 years. I don't see why they won't be able to do it for the next 5 years. So as I spoke to before, they expect their margins to expand. They were roughly looking at 55 to 60% of margins currently. I think they're going to be able to deliver on 60% plus, probably in the 62 to 64% range is where I would probably mark it out. And they're going to be doing this margin expansion through investments in their business. As they stated, they invested a lot into investment professionals and their platforms, and the majority of that is complete. Now their future fee revenue growth, they're tilting that towards their most profitable strategies, again focusing more on the profits and the higher margin businesses, and then leveraging their operating ecosystem, and they believe that will help them achieve this scale over the next 18 months. So achieving these targets will enable them to more than double the fee-related earnings over the next 5 years. Again, as you would think, if you're doubling the fee-bearing capital, then your fee-related earnings or your FRE should also double in line with that capital. So higher revenues and improved margins will drive 100% of that fee-related earnings growth. So again, here you can see the base fees, the other fees, the total fee revenues minus any costs, and then looking at the fee-related earnings here. So their base fees, they're going to double here. As you can see, the other fees, and in line with that, the direct costs. So the total fee-related earnings that are projected here, they're currently at $2 billion. Now they're going to jump up to $4.8 billion in 2028, or close to almost $5 billion as projected here by Brookfield Asset Management. And that results in a 17% compound annual growth rate. So as they state here, again, the operating leverage should allow them to grow margins 60% plus. Again, just stating that confident or capability that they believe in the Brookfield ecosystem and their management team. So as we looked at before today, fee-related earnings or FRE comprise 100% of Brookfield Asset Management's distributable earnings or DE, as Brookfield retained its carried interest on most existing funds prior to the spinout, so very important to note. Again, Brookfield Asset Management is eligible to earn carried interest on the new funds from that spinout, which will significantly contribute to future earnings. Again, we'll look at that here later in the presentation. All right, so this is just stating that benefit of that carried interest. So currently, the gross carried interest of BAM to $2 billion, resulting up to $7 billion here. I've looked at carried interest in my past presentation, so again, feel free to go back to my past videos and look at that. But again, representing huge growth here in carried interest, and this is also representing the capital that is eligible to earn that carried interest. All right, so this is going over their key value drivers. So the fee-bearing capital, or FBC, they expect it to exceed $1 trillion by 2028. And as a result, those fee-related earnings, or FRE, will grow in line and double to roughly $5 billion by 2028. The gross realized carried interest of BAM be up to $19 billion in total for 2029 to 2033. So great key value drivers here for the next 5 years and consequently the next decade. So there's additional upside that they have not included in this forecast, which I like. I like that they're pointing this out to us. So they're basically focusing on the organic growth that they have here, the things that are known and how they believe their business will grow organically. And they are not focusing on other items that may potentially come up that they may be able to take advantage of and earn additional fees or grow their business higher. Now, again, they're stating this does not include in their forecast any strategic acquisitions. So they could buy other businesses that could result in higher fees, could result in growth of their overall Brookfield Asset Management business. That is not included in the forecast. So I would basically look at this like if any of these happened, this would just be icing on the cake of that growth. Next, launching new flagship strategies and business lines. Again, they're not including this in here, but I would be surprised if they do not announce any new flagship strategies or business lines. Raising third-party capital for their insurance solutions business. Again, I would be very surprised if they did not do this. I believe that they will do probably all three of these things, but it just speaks to how management is setting expectations, and they are not including this in the forecast because they want people to focus just on the organic growth, and anything that happens here could be the cherry on the top. So again, like they've stated, they have a strong balance sheet and focus on capital allocation. I like that as an investor. I want management to think about the capital allocation implications as they relate to me. We have significant capital resources that are disposable. So again, speaking to their balance sheet, $3 billion of cash on their balance sheet. They can take on debt if they needed to, and they utilize BAM stock as a currency for strategic M&A. Again, keyword here being strategic M&A. If they're focusing on specific management incentives or management and acquisitions specifics, like if they're making a larger acquisition, they're going to do so in a way that they could dilute shareholders, but it would need to be for a specific purpose that will later prove to be accretive or beneficial to us shareholders. Again, this is just stating their strategic uses of their balance sheet, which we essentially looked at before. And we're going to scroll down again. You can look at these on your own time, but I like to focus here on these numbers. So with these strategies in place, distributable earnings should grow to, again, like we saw, $5 billion in 2028. Fee-related earnings, you're going to have some cash, equity-based compensation, and then some investment income and the realized carried interest here, essentially offsetting the cash taxes and the stock-based compensation, resulting in those total distributable earnings, or DE, of about $5 billion, resulting into that 17 to 18% compound annual growth rate. So what's really cool here is, again, if you're a dividend investor like myself or a dividend growth investor, they state that most of that cash flow is going to be returning to shareholders via dividends. So I like to hear that. I'm going to be getting paid for my investment, as they stated before. So they expect to return substantially all of their distributable earnings to shareholders. They're targeting a dividend payout ratio of at least 90% of DE, or distributable earnings, and any remaining funds could be used for stock buybacks. So again, please remember, most of these distributable earnings will be paid out to you if you invest into Brookfield Asset Management as dividends, and they could potentially use some for stock buybacks. Again, this probably will not be that accretive or that significant to you as an investor in terms of buybacks, because they're going to still be paying out 90% of those distributable earnings. So it might not take a lot out of the market for you or increase your percentage ownership by that much, but you're getting a large payout ratio and a lot of dividends. So great growth in the dividend. And again, I expect these dividends to grow in line with their earnings of 15 to 20%. So as a dividend growth investor, hearing a company state they're going to be growing their dividend alongside the rate that their distributable earnings grow, 15 to 20%, that is amazing dividend growth in my opinion, and I will take that any day of the market. So should be able to grow their dividend at an average annualized rate, like I said, of 15 to 20% over the next 5 years. I guess I jumped ahead, sorry, with future upside potential from realized carried interest and principal investments beyond that. So again, they are communicating to you that they're going to be growing their dividend at an average rate of anywhere between 15 to 20% per year over the next 5 years. Who doesn't want a 15 to 20% raise in their dividend for the next 5 years? So just great dividend growth here in my opinion. All right, so key takeaways: clear path to surpass $1 trillion in that fee-bearing capital by 2028. Again, by boosting that fee-bearing capital, basically doubling it. Please note that those earnings from that fee-bearing capital or that revenue will also be set to double, because that is the base that they actually derive their revenues on. So again, great to hear. They've built out their investment platforms and they expect to benefit from that operational leverage or those investments and expand their margins over the next few years. Again, they're targeting for 60% plus. I'd be surprised if they didn't up it to at least 62, 63, perhaps even 64%. The benefit of the realized carried interest will be additive to BAM's current stable cash flows over the long term, and they will make selective and strategic use of their balance sheet to support our growth initiatives. Again, focusing on those acquisitions or things that might not be there in the original forecast here, but they could pop up at any time, and they're ready to take advantage of those if they do those opportunities if they do present themselves. So the clear line of sight to their organic growth targets. Their objective is to over deliver. So if their objective is to over deliver, and they're communicating this to us right now, I wouldn't be surprised if they beat what they have currently projected to us. So if they projected for 15% growth, I wouldn't be surprised if they got closer to 20 or 21% growth per year. Again, management has proven that they have been able to do this over the past 5 years, so I have no reason to believe why they can't. But that is only my opinion and not something for you to go and invest in just based off of that. Again, please do your own due diligence and research. So that was Brookfield Asset Management there. And again, I just went over the financial implications. So in my opinion, just going to go back to my investment spreadsheet here. In my opinion, I have Brookfield Asset Management at 3.60% of my total YouTube dividend growth portfolio. Again, just my YouTube one, not my total overall allocation of my total stock market portfolio, but here on YouTube at 3.60%. And I have Brookfield Corp here at almost 8%. So again, Brookfield plays a large portion. So this is basically 11.6% of my total dividend growth portfolio. So it is my largest position if you are taking into aggregate of Brookfield Corp and Brookfield Asset Management. I'm very bullish on both of these. And as I stated here, Brookfield Asset Management, I really like it because very low capital business. Again, no debt, $3 billion in cash. They are projecting for their revenue or their fee related earnings to grow by at least 15% per year for the next 5 years. Again, I think it will be higher. They are paying out all of those distributable earnings as a dividend, or essentially 90% of them as a dividend to shareholders. So me as a dividend investor, I like that. I will be getting my capital back in the form of dividends. They've also kept the option open for buying back shares if they believe that BAM becomes undervalued. And I think that this whole asset management business is set to continue to grow as those funds are very long term. As they stated, almost perpetual in a lot of cases, 90% of those funds being long-term. So it's going to be a consistent source of revenue and revenue growth, which will result in dividend growth and hopefully capital appreciation of my Brookfield Asset Management stock holding. So again, that was Brookfield Asset Management's breakdown of their most recent Investor Day presentation. If you like this content, I would encourage you to hit that thumbs up button and subscribe. It keeps me motivated to keep producing this free content on this channel and sharing my investing knowledge with you, other investors here on YouTube. I do not sell a course or anything. My main goal here is to just educate other fellow investors on my channel and hopefully help them on their investing journey. So again, I hope you enjoyed the video, and if you did, please leave a comment or subscribe and like. Thank you again, and have a great day. Bye. Please note, I am not a financial advisor by any means. Please do your own due diligence when investing into companies, as investing is inherently risky, and I am not liable for any investing decisions or investing losses you may incur. Thank you again, and have a great day.